Hello, everyone. Imagine being dropped into a foreign country where you don't speak a word of the language. You can't read the signs, you can't order food, you can't ask for directions. You feel lost, powerless, and vulnerable. For millions of people, that's exactly what the world of investing feels like. It's a foreign country with its own language, filled with strange words and jargon like PE ratio, market cap, and dividend yield. This language barrier is the single biggest obstacle that keeps people from building wealth. It creates a wall of confusion that makes investing seem like an exclusive club you're not invited to. Today, we are going to tear down that wall. This video is your complete language course. This is your Rosetta Stone for the world of finance. We are going to take the 10 most essential investing terms and demystify them, one by one. This isn't a vocabulary quiz. For each term, we will go deep. We'll cover the simple definition, a real-world analogy to make it stick, and most importantly, why it matters and how you can use it to make smarter financial decisions. My promise is that by the end of this masterclass, you will not only understand these terms, but you will speak the language of investing with confidence. You'll be able to watch financial news, look at a stock quote, and know exactly what you're seeing. This knowledge is the foundation upon which your entire financial future will be built. Let's get started. Term number 1, stock or share. Let's start with the absolute fundamental. A stock, also called a share, is a small slice of ownership in a publicly traded company. The analogy is simple. Think of a pizza. A company is the entire pizza. One share of stock is one slice of that pizza. When you buy a share of Microsoft, you become a part owner of the entire company. Why does this matter? Because it changes your mindset from a consumer to an owner. You're not just buying a product, you're buying a piece of the business that creates the product. Your goal is for the entire pizza, the company, to become more valuable over time, which in turn makes your slice more valuable. This concept of ownership is the bedrock of everything that follows. Term number 2, market capitalization, or market cap. The simple definition: market cap is the total value of all of a company's shares. You calculate it by multiplying the current stock price by the total number of shares that exist. The analogy I like is weight classes in boxing. Market cap tells you the size of the company. You have heavyweights, middleweights, and lightweights. Large cap stocks, the heavyweights like Apple or Amazon, are typically worth hundreds of billions or even trillions of dollars. They are generally more stable and established. Mid-cap and small-cap stocks are smaller, often younger companies with more room for explosive growth, but they also come with higher risk and volatility. Why does it matter? Because it helps you understand the risk and growth profile of your investment. A portfolio of only small-cap stocks might have huge growth potential, but it will be extremely volatile. A portfolio of large-cap stocks will be more stable. A good portfolio often has a mix of all three. Market cap is the first filter you should use to understand what kind of company you're looking at. Term number 3, ticker symbol. This is a simple but crucial one. A ticker symbol is the unique 1 to 5 letter code used to identify a company on the stock market. It's like a license plate for a stock. Instead of typing out Apple Incorporated, you just type APPL. For Google's parent company, Alphabet, it's GOOGL. For Ford Motor Company, it's just F. Why does it matter? It's the language of execution. When you go to buy or sell a stock, you will almost always use the ticker symbol. Knowing the ticker is the practical step to finding and trading the asset you're interested in. It's the universal shorthand of the market. Term number 4, dividend and dividend yield. A dividend is a payment made by a company to its shareholders. It's a way for a company to share its profits directly with you, the owners. The best analogy is an apple tree. The growth of the tree itself is your capital appreciation. But every year, that tree might also produce apples that you can pick and eat without harming the tree. Those apples are your dividends. The dividend yield tells you how big that apple harvest is relative to the price of the tree. It's calculated by taking the annual dividend per share and dividing it by the stock's current price. A $100 stock that pays a $3 annual dividend has a 3% dividend yield. Why does this matter? Because dividends are a major component of total return. They provide a steady stream of income and are a sign of a stable, profitable company. A common mistake is only looking at the stock price. A company with a high dividend yield can be a fantastic investment even if its stock price isn't growing dramatically. It's a quick way to gauge market sentiment and valuation. But be careful. A common mistake is thinking low PE is always good and high PE is always bad. It's just one tool, and it needs context. Term number 6, bull market versus bear market. These terms describe the overall trend or mood of the stock market. The analogy is the animals themselves. A bull strikes upwards with its horns, so a bull market is when the market is rising and investor confidence is high. A bear swipes downwards with its paws, so a bear market is when the market is falling and investor sentiment is pessimistic. Technically, a bear market is usually defined as a drop of 20% or more from recent highs. A bull market is a sustained period of rising prices. Why does this matter? Because it helps you manage your emotions. Knowing that bear markets are normal, recurring part of investing history can help you avoid panic selling when one arrives. It helps you understand the long-term weather patterns of the market, not just the daily forecast. Term number 7, volatility. This is a measure of how much a stock's price swings up and down. Imagine two boats on the ocean. One is a giant cruise ship. It moves slowly and steadily. That's a low volatility stock. The other is a small speedboat. It can move very fast, but it also gets tossed around violently by the waves. That's a high volatility stock. Volatility is often measured by a metric called beta. A beta of 1 means the stock moves in line with the market. A beta greater than 1 means it's more volatile than the market. A beta less than 1 means it's less volatile than the market. Why does this matter? Because volatility is the most common way to measure risk. If you are a conservative investor who can't stomach large price swings, you should look for low volatility investments. If you have a higher risk tolerance, you might be comfortable with more volatile stocks in the hopes of higher returns. It's about matching the investment's ride to your personal comfort level. Term number 8, diversification. This is perhaps the most important concept in all of investing. Diversification means not putting all your eggs in one basket. The analogy is self-explanatory but profound. If you put all your money into one single stock and that company fails, you lose everything. If you spread your money across 500 different stocks in different industries and countries, the failure of 1 or even 10 of those companies will have a very small impact on your overall wealth. Diversification is the only free lunch in finance. It is the single most effective way to reduce your risk without necessarily reducing your expected returns. Why does this matter? Because it protects you from catastrophic loss. It is the foundation of sound portfolio construction. A common beginner mistake is to fall in love with one company and invest too heavily in it. True wealth is built on a diversified foundation. Term number 9, expense ratio. This term applies primarily to ETFs and mutual funds. The expense ratio is the annual fee that a fund charges to operate. It's expressed as a percentage of your investment.
Imagine you have a bucket to collect rainwater. The expense ratio is a tiny, almost invisible leak in the bottom of that bucket. One drop at a time, it doesn't seem like much. But over 30 or 40 years, you'll be shocked at how much water you've lost. A low-cost index fund might have an expense ratio of 0.03%. A more expensive, actively managed fund might have a ratio of 1%. That difference sounds tiny, but over decades, that 1% fee can consume hundreds of thousands of dollars of your returns due to the effects of compounding. Why does this matter? It is one of the single best predictors of future investment success. Low costs are paramount. When choosing a fund, the expense ratio should be one of the first things you look for. A common mistake is ignoring these small fees, which is a massive, wealth-destroying error. Term number 10, asset allocation. This is the master strategy. Asset allocation refers to how you divide your portfolio among different asset classes, primarily stocks and bonds. The best analogy is a recipe. You're baking a cake for your financial future. Stocks are the sugar. They provide the growth and excitement. Bonds are the flour. They provide the structure and stability. Your asset allocation is the recipe that tells you how much sugar and how much flour to use. A young investor might have a recipe that's 90% stocks, sugar, and 10% bonds, flour. A retiree might have a recipe that's 30% stocks and 70% bonds. Why does it matter? Because studies have shown that your asset allocation decision is responsible for more than 90% of your portfolio's long-term returns. It is more important than any individual stock you pick. It is the master plan for your entire financial life, aligning your investments with your age, goals, and risk tolerance. Okay, we've covered the 10 core terms. Let's tackle a few common questions that tie all of this together. Question 1. Of all these, which are the most critical for a beginner to focus on? If I had to pick two, they would be diversification and expense ratio. If you get these two right, by buying a low-cost, diversified index fund, you have already set yourself up for a higher probability of success than most investors. Master these two concepts first. Question 2. How do all these terms appear on a real stock quote? Great question. If you look up a stock like Apple, AAPL, on a finance website, you will see almost all of these. You will see the market cap, the PE ratio, the dividend yield, and its beta for volatility. Learning to read this quote box is like learning to read the dashboard of your car. Question 3. Can a company have a negative PE ratio? No. The E in PE stands for earnings. If a company is losing money, has negative earnings, the PE ratio is not applicable. You'll typically see it listed as NA. This is a quick sign that the company is not currently profitable. Question 4. Do I need to worry about bull and bear markets if I'm a long-term investor? You need to be aware of them, but you shouldn't let them change your strategy. Your strategy should be to invest consistently through both bull and bear markets. A bear market should be viewed as a sale, an opportunity to buy assets at a lower price, not as a reason to panic. Today you learned a new language. You took 10 of the most intimidating terms in finance and you mastered them. You now have the vocabulary to understand the world of investing. This is the key that unlocks the door. From this point forward, every other financial concept you learn will be built upon this foundation. You are no longer on the outside looking in. Your action item today is of reflection. I want you to go to a financial news website, find the quote page for a company you know, and just look at it. Find the market cap. Find the PE ratio. Find the dividend yield. See the language in action. If this masterclass provided you with real, tangible value and clarity, please do me the favor of hitting that like button. It's the single best way to support the channel and help this video find others who need it. And to ensure you don't miss our future deep dives, where we will put this language to use in practical strategies, make sure you are subscribed with the notification bell turned on. Finally, let's reinforce the learning. In the comments below, tell me which of these 10 terms was your biggest aha moment. Which one finally clicked for you today? I'm excited to read your answers. Thank you for investing your most valuable asset with me today, your time. Welcome to the conversation.